As we draw today's agenda to a close, I want to thank the team at the Solana Policy Institute for putting together such a great event today. It's certainly fitting to host Washington Meets Wall Street Summit right here in Chicago, where the plumbing and infrastructure of global finance was invented. For nearly 200 years, the city has served as the home base for CME Group, and more broadly, as the epicenter of risk management and derivatives trading. Looking across the room today, I see a solid range of folks from all walks of finance. And a few years ago, some critics could have argued that organizations like CME Group and foundations and technology like Solana existed in two separate universes. But if today's conversations have shown us anything, is that those worlds have not only converged, but will continue to thrive in the future. At CME Group, we've always made it a priority to listen to our clients and provide the infrastructure they need to access markets and manage risk. We continue to hear growing demand from institutional and retail investors who want to navigate their exposure to digital assets in a liquid, transparent, and regulated environment, while also enjoying the benefits and protections of centralized clearing. It's been a fascinating journey getting to this point in time. Looking back almost a decade ago, I remember the raised eyebrows and the looks that CME Group encountered when we first started exploring digital assets and products tied to cryptocurrencies. Back in 2016, CME Group, along with our partner CF Benchmarks, launched the Bitcoin reference rate. We did this to provide market participants with a credible and definitive real-time price to track Bitcoin. A year later, in response to market demand, we introduced our first financially settled Bitcoin futures contract. That was a watershed moment for us. For us, it transformed Bitcoin from a headline-grabbing experiment to a legitimate financial instrument for the markets. For the first time, asset managers, hedge funds, and individuals could access a regulated market and express a view or hedge their positions without having to manage digital assets, wallet operations, or the complexities and uncertainties of the time of crypto custody. But our clients' needs didn't stop there. As the market matured, it grew more sophisticated. The industry weathered through cycles of volatility, and with each wave of that, the demand diversified and the need for additional risk management solutions continued to grow. Every step of our evolution has been about anticipation, from introducing a range of crypto futures and options to supporting the decentralized finance ecosystem and launching our micro contracts to provide cost-effective tools. We weren't just reacting to where the market is, we were building the infrastructure for where our clients and the market want to go. When history was made with the approval of spot Bitcoin ETFs, it served as a powerful validation of that exact philosophy. Those funds didn't happen by accident. They succeeded because we were there. They were built directly on top of liquid, regulated futures markets that we spent years establishing with the marketplace. That brings us to where we stand today. In 2026, the digital asset landscape has entered a completely new era of institutional appeal, and our product line has expanded dynamically to reflect that. We've broadened our listings to include future contracts for layer one offerings like Solana, which remarkably crossed $1 billion in open interest faster than any contracts in our crypto history. We've also rolled out other benchmarks tied to XRP, Cardano, Chainlink, Avalanche, and SWI, ensuring that we cover the vast majority of crypto market capitalization. CME Group is proud to partner with Solana, Solana Labs, and the Solana Foundation on a number of key initiatives for our industry. The entire team at Solana has helped lead the way in our expansion over the last 15 months as we work together to institutionalize Solana's high-performance blockchain. Market participants stand by, ready to trade with the same confidence they have in the same core products at CME Group, whether in cryptocurrency or other asset classes. These developments are all very exciting, but aside from those great milestones, as our marketplace has grown over the years, we've also realized investors were having to mind what the industry calls the CME gap. And as we expanded our offering and grew our ecosystem, we also had to evolve market structure in response. Crypto by nature is an inherently a 24/7, always-on asset class. For an institutional desk with significant cryptocurrency exposure, the pause from Friday night to Sunday night represented a window of challenging risk. So just a few weeks ago, back on May 29th, we solved that problem and officially transitioned our full suite of crypto futures and options to a 24/7 trading schedule on CME's Globex. The immediate reception to 24/7 trading was great to see. In our very first weekend with around-the-clock trading, we saw roughly 50 million trade across all of our contracts, and then with over $450 million trading over the first 3 weekends. This wasn't just retail activity, and it wasn't just Bitcoin and Ether. We saw robust participation from institutional market makers, from prominent clearing members, and across all of the assets offered in our cryptocurrency suite. By offering that continuous liquidity, we have finally bridged the gap between traditional derivatives and the spot markets. Our clients can now react to market-moving news in real time, confidently managing their portfolios at any point, which will certainly allow the market to continue to grow and innovate from here. Along with the 24/7 rollout, we've also recently introduced volatility-based futures, which enable macro traders to gain and manage risks associated with volatility without being subject to the price moves. And just this month, we also brought NASDAQ CME Crypto Index futures to life so investors can trade a broad basket of digital assets in one capitally efficient product. As we look ahead, our focus remains exactly where it has always been: driving efficiencies, reducing operational frictions, and providing robust markets where our clients and the market can trade with confidence. Shifting for our always-on model for crypto was the next natural evolution for CME Group, and it was more clear than ever before that traditional and next-generation markets can and do operate in the same universe. Digital assets are a core component of modern global portfolios, and in step with the demand for robust pools to navigate this growing market, CME Group will be there to provide the liquidity, the transparency, and the regulated venue that market participants need to manage their risk and pursue opportunities. Thank you very much for joining us today, and I look forward to the next part of my conversation with Nick.
What an incredible role CME has played in developing crypto market structure. Thanks for sharing the evolution of all of the incredible innovative products you've built at CME over the years. You talked a little bit about the role that Solana plays, but would love to expound on how you really kind of came to conclude that the market was ready for a Solana product.
Yeah, it's a great question. I think it's something that we've talked about a lot over the years, where we did have a bit of a slow start to our journey in cryptocurrency, first focusing on Bitcoin and then expanding to ETH, and then a little bit of a hiatus for a few years. And that was done with intention and purpose. We really wanted that regulatory clarity and certainty before we expanded beyond that. And we had gotten that through various means on Bitcoin and ETH, but it was only sort of 2025 and beyond that we got that clarity for others. But what has been absolute that entire time is there was no question about what clients wanted to see next. And Solana and Sol futures were always at top of everyone's wish list. And it made really good sense when you think about its role in the broader financial ecosystem and the projects and the initiatives they were trying to take on, that folks had real exposure to that asset movement. So like a lot of our product development, we listen to clients, make sure we can build a robust two-sided market. And in this case, it was really just a matter of waiting for that clarity. And then since then, we were so pleased to have Sol and XRP futures be their third and fourth sort of like premier products of the next wave. And I've rounded it out since then, and I've kind of moved on to the indexing space. It's been great to see Solana's role not only in our markets, but also its representation in the indices as well.
You talked about how Solana was among, if not the fastest out of the gate. What are the signals you look for in gauging market demand for these products?
I think the signals come from a few different. Certainly it's inbounds that we get from clients, but it's also keeping tabs on what other product providers who are clients of ours or even potentially competitors of ours are doing in the marketplace. That is there that clear-cut demand, and whether it was things like ETF filings or watching what was happening in the structured product space, what's happening in the OTC market, what's happening in overseas exchanges. It's really sort of coalescing all of that feedback and then just really asking that question of, can we bring a product to market that not only meets the regulatory standards, but meets our standards in terms of being able to tap into that liquidity. And once we got into looking at it, I don't think there was very little dissent, I think, for Sol futures. I think the hardest question for us to always ask was, when is it coming? But you really kind of, when you're in there with clients and you see it, that the way that intersection of our wanting to bring the product, that client demand, and then sort of the place it plays in the ecosystem, it was very clear for Sol Futures.
So, as you think about client demand for new products, you just came out with the index product. Maybe double click on that, and would love to hear how it fits into the broader CME portfolio.
Yeah, for sure. So even, full disclosure, I've been at CME for 13 years. Before that, I was an equity index trader. So I have a bias towards indexing in general. And why our reference rates and real-time indices underlying our futures, why we took that index-based, financially settled approach, is the index can provide a fair amount of flexibility for addressing the nuances of an asset class or a certain asset in the marketplace, and then we could overlay the futures on top of that. So it's really an ecosystem effect. And then when you look at cryptocurrency, I think it's no different. And as that space has continued to grow, whether it's institutions or even individuals, there is a wanting for a more diversified exposure, an allocation, if you will, to the cryptocurrency space. But folks don't want to necessarily pick the right winner, or they don't want to have to choose if they're allocating their capital between token A, B, C, or D, and they want it to sort of float in that familiar, almost like equity style market cap weighted approach. And that's something that the index community has long tried to look at. And now that we also have the clarity at the asset or the token level, then building indices on that and now futures on those indices is sort of the next natural evolution. But I'm excited how these indices will grow over time, and that by design, they will fluctuate with the underlying representation of relative importance of these various tokens in the cryptocurrency asset class, which I think will be a very interesting thing to watch over the next several years.
So when it comes to market cap weighting, we talked about this in our prep call. Bitcoin is kind of the giraffe in the tent, right? It's the biggest asset by a significant order of magnitude. Talk to us about how you think about that in terms of a single asset having such a significant weight in a market-weighted index.
Yeah, I think and I still love that expression, giraffe in the tent, right? I encourage everyone to use that more because it paints such a great picture. But I think when you think about indexing, it's really about, even if you have a dominant sector or you have a dominant asset with respect to its contribution to the index price, that doesn't necessarily mean the index can't reflect the personality or the persona of the other constituents. And getting that right from a methodology perspective is you do want it to float with the assets you're trying to index. But I think what's interesting is you do have sort of Bitcoin as the predominant constituent, but the personality or the value added by the other constituents in the NASDAQ CME crypto index really makes it that broad-based representation of sort of like that total market. And I think one thing we'll see is that by design, we like the methodology that it will float. There's not a lot that kind of goes in terms of governing or capping at this point in time in the index. So I think it's really about getting that precision right in design. But why it was important for us to roll out tradable products in a certain order is that we, in arrears, it's probably not, the secret is out, but we have sort of all of the individual constituents of that index effectively now can be traded via the futures. So when you also think about it, if you don't love the concentration, or if you wanted to even overweight maybe the bottom quartile of the index, you can actually now do that in combination with futures at CME. So if you wanted, exposure of 2 through 10, let's say, and not the giraffe in the tent, you could go long the index future, short the Bitcoin future against it, and isolate that exact exposure index you want. So it's really about that ecosystem play and the interrelatedness of the liquidity of the components and the index, and then being able to do that all at one common exchange, one common clearinghouse, and enjoying those margin offsets and capital efficiencies. That's really a secret for success. And then it's similar to what we did for the single assets, can help drive growth in the ETF space or the OTC space. So really providing that flexibility by having those regulated tools at the index and the individual constituent levels, I think is a truly powerful combination.
Remind me how many constituent assets there are?
I think 8.
8.
I think we're.
And what is the selection criteria for those assets?
Yeah, so it's largely market cap weighted, and there is a rules-based approach by NASDAQ as the index administrator And I think that's what's important to note is that it is the rules-based index. And I think, they have a rebalance. So I think, for example, I think Bitcoin Cash just came in. A few quarters ago, some of the names came out where I think it was 10 and now we're still at 8, I think. It's something where it's meant to sort of evolve as that goes. And then CME, there is a member of sort of like the oversight committee of it alongside with NASDAQ and other industry professionals. So it's regulated in that regard, or designed in accordance with the principles of benchmarking. You have the regulated futures product around it. So it's really also a belts and suspenders of how those assets are looked at. And really about making sure that they are individually liquid and they can be traded and meet the criteria. But I think the key thing is rules-based. There's no sort of a proverbial thumb on the scale or editorializing of the index. And I think that's an important thing to make sure that it floats with the underlying asset class appropriately.
Well, hopefully Solana grows as a percentage of the index over time on a market cap weighted basis. But as you look at this product, and there are now some asset managers who have filed registration statements for actively managed multi-asset crypto index products, how do you see the market cap weighted versus actively managed ETFs evolving?
I think that if we look at other parts of the sort of ETF or ETP, exchange traded product landscape, I think they go hand in glove. I think there are folks that want to be passively benchmarked to the index and participate that in a little bit of just an allocate it, set it and forget it sort of way. But then there are folks that prefer that active management where they're trying to beat the market. The beauty of it, though, if I could say it that way, is that it's hard to have active management unless you have confidence in the benchmark or the index by which you're trying to actively manage to. So I think these are highly related and symbiotic ecosystems. I don't necessarily think it's an either-or choice. I think you see degrees of passive and active parts in everyone's allocation schematics or strategies or portfolios. But I think the greatest thing to see is that you just continue to see this proliferation and innovation of products. And the fact that they're tied to indices, that they're leaning into the regulated framework in the US across whether it's futures, options, ETFs, I think that's all an enormous net positive, and folks should look at all types of product structures. But I think it is fascinating to see from as my background was an equity trader, that you're seeing sort of other parts and strategies that are tried and tested and decades old in like the equity market coming to crypto. I mean, if that's not a sign of success, I'm not sure what is.
So one last question is, you talk about the index becoming the benchmark for the crypto industry. What is the benchmark for the benchmark? Is it NASDAQ? Is it S&P? Is it something else? How do you think about where this fits into a broader portfolio?
That's a great question. And I like to say, I love all my index provider partners equally. But I think they just, even when we see where we are, if it's NASDAQ or it's CF benchmarks or some of the other index providers that are also out there, I think what's fascinating is they're all taking slightly different approaches and they're trying to capture the personality of the market that is, I think, an extension of their existing core philosophies to indexing. And I think if we look at things like equities or if we look at whether it's credit or fixed income, the one thing we know is there's certainly room for multiple benchmarks. And I think they'll look to differentiate themselves that will reflect that slightly different personality. But I think we'll see that common approach of trying to capture the broad-based aspect of this new, or still relatively new and exciting asset class of crypto. And I think they'll get it right. And I think time will tell which one might be the benchmark or how do you benchmark the benchmark. But I think as a trading venue or an exchange operator, I'm like, the more the merrier, because that's more volume for us if we can get the futures contracts. And then you allow other strategies to evolve. You can have arbitrage across indices. You can isolate sort of risk parameters that maybe certain indices capture that others don't. But I think certainly room for everyone to try and figure out. And it's going to be an extremely fun journey as the market tries to figure it out.
Well, Tim, thank you so much for joining us and for all the great work you're doing at the CME.
Great, thanks, Nick.